my name is Brianna Aguilar, and I work at Montecito Bank and Trust. And I know we don't have a lot of people here right now, so feel free to stop me and ask any questions along the way. But we're really giving this workshop to help you consider things to prepare to buy a home. And so we'll be talking about budgeting and saving and kind of things that you can do to help get yourself in a place to be ready in that manner. Understanding your credit score and things that you can do from a credit perspective to be prepared, and just briefly going over the pre-approval process and qualifying for a loan. So when you think about buying a home, the monthly costs of buying a home are more than just the mortgage. You also need to factor in taxes. And so that's going to be based on the value of your property. And there's different ways, depending where you live, your property taxes are different amounts. And so there's ways in which you can estimate that online, and they can help you. Your realtor or your loan officer can help you understand estimates to understanding what your taxes would be. Home insurance is another thing. So if you are going to finance a home, you must have home insurance. And so that's going to be a monthly cost as well. Additionally, if you do live in a flood zone, you will be required to have flood insurance. So that's another additional cost that's potential. There's not a lot of flood zones in our area, but kind of depending, especially with some kind of recent fires, there are some flood zones. And then the other option in California in particular that you need to think about is earthquake insurance. And sometimes that can be about equal to what your home insurance costs are. And so that's another expense for you to think about. The other last thing is private mortgage insurance, or PMI is what it's referred to. And if you have a loan that is more than 20%, if your loan to home value ratio is more than 20%, so you don't have at least 20% equity in the home, then you will have to pay private mortgage insurance. It's a small percentage. And then once you increase and your loan to value ratio is below that 20%, you do not, or above that 20%, you have more than 20% equity in the home, you do not have to have that private mortgage insurance, and it will fall off. But it's just a way to guarantee for your lender that if you do lose a home, that they're not going to be stuck with a home that is worth less than what you owe. So one of the most important things as you're preparing to buy a home is to make your budget and really see, what can I afford? What is that monthly payment, and all inclusive of all those different expenses that we talked about that you can afford. When you're thinking about buying what your housing expenses are, you really don't want it to go over 30 to 40% of what your total budget is. So that's something to think about. But a budget, it's a really simple thing to do, but it's something that a lot of people, we make budgets, but we don't always follow them. When I teach these classes to students, I say when you write down your homework, it's a way to keep track of what your homework is. But if you don't go back and look at that list and actually check it off, then it's not really doing any good for you. So the process of making a budget is really, first you want to track your daily spending. And that will help you determine really what your monthly expenses are. So this worksheet right here, you can use to track your daily expenses. And it's really, some people will do things like food journals or exercise journals, and it's the same kind of concept. But every day when you spend money, write down what you spend, because I can say I want to spend this much on food, this much on gas, but it's all estimates in my mind, right? And this will help us track what actually the expenses are. So this is a really good thing that you can use. And then at the end, you're going to then at the end of the month, plug those amounts in here to see what you actually spent in that month. And so a good kind of challenge that you can do is set kind of what you think your budget goals, what you think you're going to spend. And then at the end of the month, enter this information in, and then you can see how it compares goal to actual, and identify places that you can make changes. Are there things that you can do in order to decrease your daily spending? And of course, you also want to determine your income. And for people who have a regular job and have consistent hours, that's pretty easy to do because you have a consistent paycheck. But sometimes, especially if, let's say, you're in an industry where you make a lot on tips, that can fluctuate, or your hours can vary. That's something to think about. So when you're making a budget, you want to go over kind of what your average income is. And then you want to find ways to decrease spending so that you can increase your savings. But those are kind of just some general tips. And I suggest you revisit your budget every few months once you've gotten a habit in it to make sure that you're really sticking to it. One of the biggest things when we do this exercise that people will identify is, I don't need to spend this much eating out of the home or buying coffee out of the home. Those are the biggest, easy places where you can save money. So now we're going to talk about saving for our down payment. So your down payment depends on the type of loan that you'll get. A traditional loan is going to require at least a 20% down payment. So if you buy a $1 million house, you're going to have a $200,000 down payment. But there are other types of loans, like an FHA loan, that can require as little as 3.5% down. And so those are for people who are first-time home buyers. And then there's also VA loans, and some of those are for veterans, and they may not require a down payment at all. But there's only certain lenders who can do VA and FHA loans. So when you're looking into this process, you're going to want to evaluate different types of lenders that you can go to, and they can help you with that. And just as a reminder, no matter which type of loan you get, if you put less than 20% down, you will have to pay that private mortgage insurance. There's lots of different ways in which you can, get a down payment. One is saving your own savings that you have. A gift, if you have a family member or somebody who is donating money to you, that can also be counted towards your down payment. You are allowed to borrow from your retirement plan, so your 401k, you can borrow from yourself as a source of a down payment, but you do have to pay yourself back with interest. So you just need to make sure that you understand kind of what that impact is going to be for you. There are a number of down payment assistance programs as well. So the Federal Home Loan Bank of San Francisco has a program called WISH, which is, it's something workforce, something for home ownership, but it's for the Federal Home Loan Bank of San Francisco. And there's different banks throughout California that partner in this. So Montecito Bank and Trust is one of those banks, and so we do WISH loans. And so what that is you have to save money, but it's a 1-to-4 matching program. So for every dollar that you save, the Federal Home Loan Bank will give you $4, up to $22,000. So it's a really good way to get some down payment assistance, and it is only available for people who are low to moderate income. And so those are based on HUD guidelines, and you can look those up, or you can always contact me if you want at Montecito Bank and Trust. I oversee that program. But every year, the Federal Home Loan Bank releases funds, usually in March or April, that are available for the following year, for that year, until they run out. So funds for this year have just run out, but there'll be funds next year again. They're also through the Santa Barbara County Housing Trust Fund. There's a workforce homebuyer fund, and they will lend money. I believe it's up to $100,000 towards a down payment, and you will have to pay that money back. But it's a great way to be able to get a down payment, because oftentimes that's the hurdle for people getting into a home is, how do I get enough for that down payment? I can afford the monthly payment. I can afford the taxes and everything else, but how do I get that monthly payment? So the Santa Barbara County Housing Trust Fund Workforce Program has this home buyer fund that you can take advantage of, and all the information is available on their website, and it is available. They have programs for low to moderate as well as middle income home buyers. So there's a wide range of that. There's also a program through Cal FHA, which is called My Home Assistance. And that program also will help give you savings towards a down payment as well. And those are often done as grants. Some of them are loans, but it kind of varies. But it's called the My Home Assistance through Cal FHA. Are there any questions on any of those programs? So there's the WISH program, which is through the Federal Home Loan Bank of San Francisco. And so that's a program that banks, different financial institutions throughout the state participated, and you have to work with a bank that will sponsor your application for that program. But the Santa Barbara County Housing Trust Fund is the down payment assistance program up to $100,000. And it sounds like they'll be at the next workshop, so they'll be able to answer questions. But there are a variety of resources out there, and so especially focused on first-time home buyers and low to moderate income home buyers. And so it's just great. There's a lot of kind of incentives out there for people to buy homes. But as we mentioned, one of the ways for your down payment is savings. So you want to just try to build up your savings. So there's some tips on how to make that possible is making it automated. If you can set up those automated transfers coming directly out of your paycheck or from your checking account to your savings account, then you don't even see the money, right? It just goes into that account and you pretend it's not there. Set up an emergency savings account as well, because while it's important to save for that down payment, you want to have that emergency savings fund that you're building towards, because if things happen, you don't want that to derail your ability to have to dip into that housing fund that you've been working so hard for as well. Set small goals and big goals. It helps keep you motivated along the way. Like I mentioned during the budgeting, reduce eating out. So if instead of buying coffee one day a week, put that money into your savings account and then incrementally raise your savings over time. So this is just something that I will share with you about how you can start to track your savings. Having something visual can help you stay motivated and help you keep track of how you're working towards that goal. And so you can set small goals and big goals, and having different ones that you achieve can help keep you motivated. And then the last sheet is just a 52-week savings challenge. This is a good thing to do, especially if you have youth in your family, or if you're trying to save kind of a smaller amount of money or get started on that emergency fund. It starts with 25 cents a week that you save, and it increases incrementally over time. And it's just a good way. You think, oh, I can save a quarter a week. I can save 50 cents. And so it's just a way to kind of get you on that road to savings. So credit, that is one of the biggest things that's important for you to be eligible for that loan. There are 5 C's of credit that lenders look at when they're evaluating whether to give you a loan or not. So the first one is character, and that's based on indicators like your credit report and your score and your payment history. So that's your credit profile. We'll be talking about your credit score in particular in just a minute, but that's giving us kind of a picture of what you are as a borrower. Capacity, that's your ability to pay back. And that's when we're going to look at your debt to income ratio. So we're going to look at all of the debt that you have as compared to your income. And so that's something that your mortgage lender can explain to you, but we're going to look at that. So how much you owe versus how much you make. Because they really want to know that you're stable enough to continue that mortgage payment. The third C is collateral. And so that's the item that you're pledging against the loan. So in this case, for a mortgage, it's the home. And so they're going to look at what is the value of that home and how much are you borrowing. So they're going to be looking at that to see kind of as they evaluate your loan as well. And then capital, which are the savings, investments, and other assets that you're using to purchase the property. So how are you making that purchase? And then the final C is conditions. And so that's going to include factors like, why are you getting the loan? What is your interest rate? And what is kind of the current economic climate? So those are kind of the 5 C's that they're going to look at to evaluate whether they want to give you kind of, how are you as a borrower? So your credit score. It's a number that is based on all of the information in your credit report, which your credit report is all the money that you have borrowed, loans that you have had, all of this information. And it's a number that predicts how much of a credit risk you'll be. And there are 3 major credit bureaus that you have in the United States: Equifax, Experian, and TransUnion. Each of them have their own unique algorithm for how they calculate your score. So they may be slightly different, but they should be close. If one is way higher or way lower, there's something going on. So you'd want to look at that credit report to see what they have. But your score can range anywhere from 300 to 850, 850 being the highest score you can get. 35% of that score is your past payment history. So whether you pay your bills online, that is the most important factor in determining your credit score. Outstanding debt is 30%. So that's how much you owe. And when we talk about outstanding debt, it's not just the total number, it's how much credit you. So let's say you have a $10,000 credit card and you're always carrying a balance of about $5,000. That means that you're utilizing 50% of your available credit. So that's going to make your credit score go down. You want your credit limit, so what you're using of all the available credit that you have to you, you want it to be less than 30%. So say you have 6 credit cards and they all add up to $10,000, you want the total balance to be $3,000 or less. How long you've had credit is another thing. So that's 15% of your score. So an 18-year-old cannot have as good of a credit score as a 25-year-old because they're going to look back 7 years, right? So all your late payments, everything, they look back 7 years in your score. So those payments that you make on time are going to help improve your credit score the longer you've had it. So that's the other thing is if you have credit cards, and let's say you have a credit card that you opened a long time ago, 7 years ago, and you got a new one, if you close that credit card, it's going to close down your credit history for that as well. So you want to keep it open just because you don't want that credit history to disappear. New applications for credit is 10% of your score. So when you know that you're going to buy a home, don't go out and apply for a car loan, a bunch of credit cards, because your score will dip slightly when you apply for loans. So you want to make sure that you're not out there applying for a bunch of new credit. And then the types of credit is 10%. So we have something that's considered good debt and bad debt when we look at kind of your credit. And so good debt is things like a home loan because that's an item that you're purchasing that is probably most likely increasing in value over time. So it's an asset you're going to own. Bad credit is going to be something like a credit card, right? When we have high balances of credit cards that we keep month over month and we don't pay it off, then our credit score can go down. So we want to make sure that we are having better. So even though if you have a mortgage and it's a big number, right, you have $500,000, that's considered good credit because it's a value that's increasing over time. The next slide just shows you kind of where the good credit scores, fair, very poor kind of cuts off. Really, you want to be in that 700, 720 and above is where you're going to get the better interest rates and all of that. So those are things for you to consider. Do you have any questions about credit scores? 700 or really 720 is where you're going to get kind of better and even more. As you go higher and higher, you're going to get better interest rates, but you really want to be above 700. If you're a cosigner, it's not, as long as the car payment is being paid off every month and you don't have late payments, then it's fine. But anything that you are a cosigner on is going to show up in your credit report. So that's a thing. When you agree to be a cosigner, you want to make sure that person is going to pay that loan on time, because if not, it can damage your credit. So one of the things I know when I first kind of started learning about a lot of this, I was like, I don't really want to know my credit score. It makes me nervous. I don't want to see if there's bad stuff out there. But it's better to know, because when you start that home buying process, you don't want to be surprised. So there are lots of free apps out there like Credit Karma. I know at the bank we offer one within our mobile app called Credit Pulse, and they track your credit score. And you can look in there and it'll break down your credit score and give you an idea. It's actually going to give you your educational score, which is not your score that they're going to pull when you get your mortgage, but it's going to give you a pretty good sense of what your credit score is. But I really like these apps, although it was scary to do it. When you look in there, it helps you see, okay, what are all the things on my credit report? Am I aware of all of this? And it will also give you recommendations of things that you can do to improve your credit score. So it's a really good thing to do, and you can have alerts. That way, if somebody opens up credit in your name, because there could be things that are wrong on your credit report. Either you could have been a victim of fraud, or there could just be an error. So it's just important for you to be aware of that. And then, like I said, all those numbers are calculated off your credit report. every year you can get a free credit report from annualcreditreport.com, and they will give you your credit report. It's not going to give you your score, but it's so that you can review that and make sure all that information is correct. Okay, so choosing a lender. That can be like, who is the best mortgage? There's lots of different things out there. Don't always go with the first person you know. So Montecito Bank and Trust, I will say we have great lenders, but talk to multiple people. You want to go out there and see what the best loan is for you. Compare what they're offering. Ask questions. If a mortgage loan officer seems hesitant to answer you, that's a red flag to me that they're not somebody I would want to work with. They should be there. Their job is to educate you and make sure you understand every step in the process. Before you sign any document, make sure you understand everything. If there are fees in there, if there's a document that you didn't know about, or they're like, oh, yeah, that's fine, just sign it, do not sign it. You want to make sure you understand everything. And again, a good mortgage loan officer is going to make sure that there are no surprises along the way, and they're informing you of each thing so that you can ask those questions. So when you're going through, there's so many documents when you buy a home, and so you just want to make sure you understand all of those things, and they should have been educating you along the way with that as well. If you're not sure, don't sign. Get advice from a reputable housing counselor. There's lots of different housing classes that you can take out there. I know when we do the wish loans, we make sure all our buyers go through a home education process. They have to go through that as a condition of that, because we want to make sure people understand what they're getting into. So there's a pre-approval process that you can go through. Right now, the housing market is super competitive. Housing is going very, very quickly. And so having a pre-approval letter really helps you stay kind of in the game during the purchase process. So once you've decided on what lender you want to go with, you can go and get what's called a pre-approval letter. And they will work with you, and they will they're going to ask you for some documents showing what your income is and kind of other stuff around debt and things like that. And then what they'll do is they're going to give you an estimate of how much you would be approved for a loan. And then you'll have that letter to work with your realtor, and they'll be able to show the people who are selling their homes, oh, this buyer is serious. They've already been pre-approved. And it's a formal letter that is very much preferred by realtors and sellers. There also is a pre-qualification process that you can go through, but right now, because of the way the housing market is, those pre-qualification letters, there's less vetting that's done. There's less information that banks go through to be able to authorize those. And so sellers and realtors don't want those as much. They really are wanting the pre-approval letters. But you can get that. But when you are getting pre-approved, some documents you may need are your W-2s for the past 2 years, 2 years of tax returns, your bank statement for the last 2 months, your most recent year-to-date pay stub. If you are self-employed, they're really going to, since you won't have a pay stub, they'll probably ask you for your year-to-date profit and loss statement. So those are things that if you're self-employed, they just may ask for those things. Any questions about that?
I have a question
Yes.
for self-employment. Let's say that you just started self-employment, like, Grubhub, Uber, and you haven't filed taxes. You've done it for a couple of months. Will that help you qualify for a higher loan? How much time will you need to be doing that?
So it's going to be kind of a challenge since you don't have that history. So one of the things they're looking for is stability. And so having that historical information is something that's important. So it can be a potential roadblock. So when you're getting a loan, they're going to look again at your credit history, your pre-monthly tax income, your different monthly expenses that you have, and what your down payment is going to be. And again, that's where we come back to your debt to income ratio. So that you're looking at what are your monthly debt payments. So what are all the expenses you have every month as compared to your gross monthly income. Just some things that can help during the home buying process. Be aware of all the issues with the property you're purchasing. If there's issues that you knew of and you didn't disclose to your lender, it can delay the loan. Prepare all your documentation, get all of that together. Disclose any sources of income or debt that might show up. You want to make sure, even if you're not sure it's important, if it pops up and it's an issue, then again, it can delay the loan and potentially jeopardize you getting that home. And then, again, a last couple things, getting new debt. Do not do that during the home buying process. If you have started the home buying process, do not apply for new credit cards, anything like that. Wait until the loan closes. Switching jobs, if possible, do not do that because that's going to question your stability of your income. And so you really don't want to switch jobs until after you close a loan. Going on vacation, because you may not be available to sign something or look at something. So if you know you're buying a home, don't go on vacation where you're not available or able to get here quickly. And then incomplete or incorrect documentation. You just want to make sure you have all the information that's possible. So that's our workshop. If you have any questions, please feel free to reach out to us. But thank you.
Thank you.